Yes, today I want to talk about my updated models for the Fed funds rate and the Australian cash rate. A couple of weeks ago, I talked about how when I looked at the components of our Australian cash rate model, which are unemployment, inflation and inflationary expectations, that what needed to happen as we go forward was that for rates to decline, the unemployment needed to rise. Last week I spoke about the US economy, and I said that there's very, very strong growth in the US economy, and it's driven by large budget deficits. And that, of course, means there's an increasing finance cost, and that has generated a rise in bond yield over the last month. Now, our models interpret that rise in bond yield as a rise in inflationary expectations. And as the Australian bond yield has gone up with the US bond yield, not as much, by the way. This is basically a sell-off in US treasuries in which, say, German bonds and Australian bonds haven't followed to anything like the extent that we've seen the sell-off in US treasuries. But if we update those models, again, based on inflation, unemployment and inflation expectations, what we find is the fair value of those models has risen significantly over the last month. So a month ago, the fair value of the Fed funds model was 397 basis points. Running the model this morning, that's risen this morning to 441 basis points. Now, of course, the Fed funds rate is 535 basis points. So if that stabilises, that has only to stabilise where it is and go forward where it is, but there'll still be enough room for the Fed to cut rates, say 3 rate cuts by the end of the year. But that's not the situation in Australia, because whereas the Fed funds rate is 533 basis points, the Australian cash rate is a 4% lower, of 433 basis points. So what might allow enough room for rate cuts in the US, and there's still room for rate cuts in the US, doesn't leave enough room for rate cuts in Australia, unless, of course, as I said 2 weeks ago, unemployment goes up from here. So our model for the Australian cash rate a month ago was 401 basis points, which gave us room for a rate cut. But given what's happened, that model has now risen with increasing inflationary expectations perceived in the market to 444 basis points, which doesn't give you enough room for a rate cut this year. So unless something happens to the fundamentals in the model between now and the end of the year, that rate cut, which was forecast in the source of the forecast actually was the summary of economic projections provided by the RBA in February, where they showed rates falling to 3.9% by the end of the year. Unless something happens to fundamentals, then that rate cut is off the table. Now, what could happen? As we said 2 weeks ago, what needs to happen for that rate cut to occur at the end of the year is Australian unemployment needs to go up. Now, in the summary of economic projections provided in February, with that rate cut forecast, the RBA also said that it expected that unemployment, which is currently 3.8% in Australia, would rise to 4.2% in June and rise to 4.3% in December. Now that means that unemployment in Australia needs to rise fully 40 basis points, almost 0.5% between now and the end of June, and rise by 50 basis points fully 0.5% between now and the end of December. If that occurs in the model, there's still a possibility of a rate cut. But is that going to happen? Well, we'll just have to wait and see. Of course, there's a lot of immigration in Australia right now, which means large additions to the labour force, and the Australian economy is not growing as rapidly as is the US. So it's possible that we could get that unemployment to make a rate cut possible. But right now, the model says unless there's a change in fundamentals, the expected Australian rate cut is off the table.